Okay, get this. Have you ever seen a company announce they might print a ton of new shares and then their stock price actually goes up? I mean, it sounds like it completely breaks the laws of finance, right? But that's exactly what's happening with Bitmine. They've filed to raise a huge amount of money, and for some reason, the market seems to love it. So, what's going on here? Is this a massive mistake or is it pure genius? Let's break it down. And when I say huge, I mean $20 billion. And that's on top of what they've already raised. We're talking about a total potential war chest of nearly 25 billion. Now, a number like that would normally send investors running for the hills, screaming, but not this time. And that brings us right to the heart of the mystery, doesn't it? It's the multi-billion-dollar question. How in the world can a company plan to potentially flood the market with new stock, and yet the people who already own that stock get richer? It just doesn't seem to add up. Well, that's the puzzle we're going to solve right now. All right, to really get this, we've got to pop the hood and see how they're actually raising all this cash. It all comes down to a really specific strategy called an ATM offering. Okay, so the first piece of the puzzle is this thing called a prospectus. You can think of it as the company's official game plan that they have to file with the government. It tells everybody three key things: what they're selling, in this case, more stock, what they're going to do with the money, which is buy a ton of Ethereum, and of course, all the risks involved. The easiest way to think about it is like a friend's lemonade stand, right? Their prospectus is just them saying, hey, give me $5 to buy more lemons, and I'll give you 10% of the profits. But just so you know, if it rains, we're all going to lose our money. It's just a plan, a promise, and a warning, all rolled into one. Okay, now here's where things get really clever. Bitmine is using what's called an at-the-market offering, or ATM for short. So instead of dumping a giant block of shares all at once and totally crashing the price, an ATM lets them sell shares little by little directly on the stock market at whatever the price is at that very moment. It gives them like surgical precision. So the process is actually pretty simple, but it's brilliant. First, they wait for their stock price to be trading high, at a premium. Then they start selling small batches of shares right into the market. This raises cash instantly without causing a big panic. And then, bam! They take that cash and immediately use it to buy more of their main asset, which is Ethereum. It's a smooth operation that avoids a big price crash. Okay, so we get the how, but that still doesn't answer the number one fear that news like this brings up for any investor: the dreaded D word, dilution. And look, that fear is totally justified. We're talking about a potential 240% increase in the number of shares out there. And conventional wisdom tells you, right? If you have a pie and you suddenly cut it into way more slices, your slice is going to get a whole lot smaller. And this isn't just some abstract fear. Investors have been seriously burned by this before. I mean, just back on July 9th, Bitmain announced a much smaller $2 billion plan. The market completely freaked out, they panicked about dilution, and the stock price just fell off a cliff. It plummeted from around $160 all the way down to 40. A total catastrophe. So, if the market punished them so badly for this before, why on earth is it working this time? Well, it's because the real goal here isn't dilution at all. It's actually the complete opposite. It's a really powerful idea called accretive issuance. Accretive issuance. Now, that is the secret sauce. It's this wild strategy where, you issue new stock, but you do it in such a smart way that the amount of assets backing up each individual share actually goes up, not down. You're literally making every single share more valuable than it was before you sold the new ones. Let's go back to that pie analogy. So, dilution, that's just creating more slices of the same exact pie. Your piece gets smaller. But accretion, that's different. That's like a magic trick where selling new slices somehow helps you bake a much, much bigger pie. So even though there are more slices, your new, smaller-looking slice is actually worth way more than your old one. And here is exactly how they pull off that magic trick. Check out the math. Let's say Bitmine stock is trading on the market for $60, but the actual Ethereum backing that one share, what we call its net asset value, or NAV, is only worth $30. This creates this incredible gap, right? It means they can sell one share for $60 in cash and then immediately turn around and use that $60 to buy 2 shares worth of new Ethereum. They're literally using their own high stock price to gobble up assets at a discount. Okay, that all sounds great on paper, right? But has it actually worked? Well, let's look at the data and see what's happened since Bitmine really started doing this. And wow, the results are pretty staggering. This research from Pantera Capital shows that between late June and mid-August, the number of Bitmine shares went up by 147%. But in that exact same time frame, their total holdings of Ethereum went up by 972%. That's not even close. The asset growth is just completely blowing the share growth out of the water. So here's the bottom line, the most important part. Even with 147% more shares floating around, they bought up ETH so fast that the amount of ETH backing every single share shot up by 334%. That's the proof, right there. That is accretion in action. Every share is now backed by way more assets than it was before. But why go through all this trouble? Why this incredibly complex financial maneuvering? It all comes down to one massive high-conviction bet. Bitmine's CEO, Tom, he's on the record saying he believes Ethereum could hit $25,000 by 2028. So all of this whole strategy, it's just a machine designed to acquire as much of that one asset as possible, as fast as humanly possible. So it's really, really important to get this. That $20 billion isn't just going to get dumped on the market tomorrow. The company calls this their dry powder. Think of it like a war chest. It's ammunition they now have the legal green light to use, but they're only going to fire when the conditions are absolutely perfect to pull off this accretive magic trick. So that leaves us with one final big question. Is what we're watching here a revolutionary new playbook for corporate finance, a new way for companies to build wealth? Or is it just one of the biggest, most high-stakes bets ever placed on the future of crypto? The answer is probably a little bit of both.